A day for the history books, the stock market on a rocket ride.
The Dow up, gold up, oil up, real estate up.
Revenue also came in better than expected, $44.8 billion.
I will tell you, I've never seen anything like it.
Holy fucking shit is the craziest I think I've ever seen.
Banks are taking these ideas and applying them in ways that they'd never expected.
On October 19th, 1987, the Dow Jones lost 508 points in a single day. A shocking 22.6% drop that wiped out trillions of dollars faster than you could blink. But here's the thing that'll blow your mind. That catastrophic day was just one chapter in a story that began 385 years earlier. That day was just one small part of a story that began hundreds of years earlier. In a time before computers and fancy stock charts. So how did the earliest investors keep track of a stock's price? The answer will surprise you. This is the entire history of the stock market. Welcome to Home of Finance. Subscribe to help us on our journey to 1,000 subscribers. On March 20th, 1602, the Dutch East India Company announced the world's first initial public offering. They had no idea they were unleashing a system that would topple governments, create billionaires overnight, and drive ordinary people to jump from buildings. I'm warning you right now, some of what you're about to hear will fundamentally change how you think about money, power, and the invisible forces that control our world. Because what started as a simple way to fund spice trading ships would become a beast so powerful that it could drop 89% and drag the entire world into the Great Depression. When this video ends, you'll understand why every major world event, every war, every crisis, every breakthrough, all comes back to this one invention from 1602. But first, let me take you back to Amsterdam where it all began. The Dutch were absolutely dominating global trade. Ships loaded with spices, silk, and precious metals are making certain merchants incredibly wealthy. But there's a problem. These trading expeditions to Asia cost a fortune. A single voyage could bankrupt even the wealthiest merchant if the ship sank or was captured by pirates. So the Dutch came up with a brilliant solution. The Dutch East India Company's IPO was announced in their founding charter, stating that all the residents of these lands may buy shares in the company.
All the residents of these lands may buy shares in the company.
Here's how it worked. And honestly, it's simpler than you think. When you buy a share, you literally own a piece of that company. If the company makes money, your share becomes more valuable. If it loses money, your share becomes worthless. The price? That's just what people are willing to pay for it at any given moment. For the first time in history, regular people could own a piece of a massive trading empire. Bakers, blacksmiths, shopkeepers, they could all buy shares and profit from expeditions to the other side of the world. But here's what's wild. There were no computers, no digital displays, no real-time price feeds. Prices were tracked by hand in massive ledgers. Traders would literally shout prices across crowded rooms, and clerks would frantically scribble down every transaction with quill pens. The current price of a stock was whatever the last guy paid for it.
10 for the East India Company. 15! Going once, going twice, sold for 15.
The Amsterdam Stock Exchange originated in 1602 and was originally limited to trading Dutch East India Company shares. But here's where things get dark. Within days of the launch, buyers had begun to trade shares, and soon the public was engaging in a variety of trading activities. Speculation, market manipulation. The same toxic behaviors we see today. See, the Dutch East India Company's ships would disappear for months, sometimes years. No one knew if they'd return loaded with treasure or if they'd sunk to the bottom of the ocean. This uncertainty created the perfect breeding ground for rumors, panic, and manipulation. Wealthy merchants would spread false news about ships being lost just to drive down prices, then buy up shares cheap. Sound familiar? When ships did return successfully, share prices would explode overnight. Some voyages predictably failed, but the ones that were successful brought promise of wealth. By the 1630s, this system had evolved into something much more dangerous. The Dutch had moved beyond just trading company shares. They were now trading contracts for tulip bulbs. And what happened next would be the first recorded market bubble in history, a preview of every financial disaster that would follow. Tulip prices went absolutely insane. A single bulb was selling for more than a house. People were mortgaging their homes, selling their businesses, all to buy tulip contracts. And then in February 1637, reality hit. The tulip market collapsed overnight. Fortunes vanished, lives were destroyed. And the Dutch learned a harsh lesson that humans would apparently need to learn over and over again for the next 400 years. But the stock market itself survived, and it was about to spread across the world like a virus. What was about to happen next would permanently change the world forever. The concept of stock trading crossed the ocean to America in the 1790s. On May 17, 1792, 24 stockbrokers signed the Buttonwood Agreement under a tree on Wall Street in New York City. They had no idea they were creating what would become the most powerful financial district on Earth. For decades, the American stock market grew steadily. But even in those early days, there were signs of what was to come. September 24, 1869, a date that would become known as America's first Black Friday. But this wasn't about stock market crashes, it was about something far more audacious. Two men, Jay Gould and James Fisk, had just attempted the most brazen market manipulation in American history. They tried to corner the entire gold market of the United States. They realized that there was only around $20 million of gold in circulation at a given time. So a speculator could potentially buy large portions of gold, corner the market, and drive the price up for a hefty profit. Gould and Fisk formed what became known as the gold ring to corner the gold market and force up the price of the metal on the New York Gold Exchange. But for this to work, they needed the US government to stay out of their way. Here's where it gets truly insane. If a speculator like Gould tried to corner the market, President Grant could simply order the Treasury to sell off huge amounts of gold and drive the price through the floor. For his gold scheme to work, Gould needed President Grant to keep a tight grip on his purse strings. They were able to manipulate the market due to ties to the president's family. They got close to Grant's brother-in-law, convinced him to lobby the president, and even brought Grant's family on luxury trips to influence policy. For weeks, their plan worked. They quietly bought up massive amounts of gold. Prices started climbing. Other speculators, seeing the trend, jumped in. The gold market was heating up dangerously. But President Grant wasn't stupid. On Friday, September 24th, Grant realized what was happening and ordered the release of $4 million in gold. The move drove down the price and stopped the gold ring's attempt to corner the market. The gold market collapsed instantly, resulting in a panic that caused the price of wheat to drop by more than 30%. But here's the truly maddening part. Gould had inside information. While other investors were being destroyed, he had already started selling his positions. The deal would have netted him $12 million if it had worked, equivalent to hundreds of millions today. The scandal rocked the Grant administration. The press called it the most shameless attempt at market manipulation in American history. Sound familiar? This was perhaps the most scandalous instance of manipulation ever, until it wasn't. Because this pattern of wealthy speculators trying to rig entire markets? By the 1920s, the lessons of 1869 had been forgotten, and something far more sinister was happening. The 1920s became known as the Roaring Twenties, marked by a surge in stock market participation, fueled by speculative investments and buying stocks on margin. Here's what buying on margin means, and why it was so dangerous. Instead of paying the full price for stocks, people were borrowing money to buy them. You could put down just 10% of a stock's price and borrow the other 90% from your broker. This worked great as long as stocks kept going up. If you bought $1,000 worth of stock for just $100 down and it doubled to $2,000, you made $900 profit on a $100 investment. People thought they'd discovered a money printing machine. But what goes up must come down. Because October 29th of 1929 became what we now know as Black Tuesday, the stock market declined nearly 13%. But that was just the beginning. Remember all that margin buying? When stocks started falling, brokers demanded their money back. But people didn't have it, so they were forced to sell their stocks at massive losses to pay their debts, which drove prices down even more, which forced more people to sell. It was a death spiral. Almost 3 years later, in July 1932, the Dow closed at $41.22, a whopping 89% below its pre-crash peak. The crash and ensuing Great Depression cannot be attributed to just one event, but the stock market collapse was the trigger that pulled the entire global economy into the abyss. The government scrambled to create new rules. The Securities and Exchange Commission was formed. Margin requirements were increased. They thought they'd fix the system. The market recovered through the 1940s and 50s. Then came the swinging 60s, and people started getting cocky again. By the early 1970s, the market was riding high. Then came inflation, Vietnam, and Watergate, which began in early 1973 and ultimately led to a stock market decline of 51.9%. Once again, the stock market proved that it wasn't just about companies and profits. It was a mirror reflecting every fear, every uncertainty, every crisis in society. But the worst was yet to come. By the 1980s, everything had changed. Computers were taking over trading. Algorithms were making split-second decisions. The market was faster, more complex, and more dangerous than ever before. The 1980s were a golden age. Ronald Reagan's policies had unleashed a new wave of capitalism. Everyone was making money again. Until Monday, October 19, 1987, which became known as Black Monday, the largest single-day percentage decline in U.S. stock market history. The Dow fell 22.6%, and in the week following an additional 6% drop. But unlike 1929, this crash didn't lead to a depression. The market recovered within 2 years, giving people dangerous confidence. The 1990s brought the internet, and with it, a new kind of madness. Companies with no profits, no products, sometimes nothing but a website, were worth billions of dollars. The NASDAQ, loaded with tech stocks, went absolutely parabolic. But by March 2000, reality set in. The dot-com bubble burst. Trillions of dollars vanished as investors realized that most of these internet companies were worthless. But the market recovered again. And by the mid-2000s, a new bubble was forming. This time, it wasn't tech stocks or tulips, it was houses. Banks were lending money to anyone with a pulse. People with no income were getting million-dollar mortgages. These mortgages were then packaged into complex financial instruments and sold to investors worldwide. Wall Street had turned the stock market into a casino, and everyone was betting on housing prices that could only go up, except they didn't. In 2008, the entire system collapsed. The Dow lost more than half its value. It took until 2013 for the stock markets to fully recover. Today's stock market isn't just different from 1602, it's different from 2008. On May 6, 2010, the US stock market experienced a flash crash that wiped billions of dollars off companies like Procter & Gamble and General Electric. The crash started at 2:32 p.m. In just minutes, 1,000 points disappeared from the Dow. Why? A single algorithm gone rogue. A computer program made a bad decision, and in the time it took you to grab a cup of coffee, billions of dollars vanished. Now we have trading apps on our phones. Teenagers are making millions trading options they don't understand. Reddit forums are moving stock prices. A tweet can crash a company or send it to the moon. Seems like people already forgot the lessons of those before us. Thanks for watching Home of Finance. Subscribe and help us on our journey to 1,000 subscribers.